Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again David McAlvany. David is the president he's the president of the McAlvany Financial Companies. It's McAlvany Wealth Management and ICA. That's a precious metals brokerage firm. And David has become a frequent guest on this show, so I won't read his entire bio, but I do think that it would behoove you to learn more about him and the companies that he is in charge of by visiting any or all of the following websites for precious metals. That's the ICA part of the enterprise. Go to McAlvanyICA.com. That's McAlvany for wealth management. There's MWealthM.com. And David also provides a weekly podcast, very interesting conversation that he has with his colleague. It's very informative, very timely, and sort of keeping up with what's going on in the world. Always entertaining and very informative. It's McAlvanyWeeklyCommentary.com. McAlvanyWeeklyCommentary.com. David, thanks for joining me again.
Jay, always a pleasure.
You know, before we get started, I noticed that one of your firms, McAlvany Wealth Management, is providing a conference call addressing the subject of how to survive an equities melt-up. And it's scheduled for this Thursday, January 23rd at 4 p.m. Eastern Time. Is this open to the public? And if so, how can people tune into that?
It is open to the public. It's going to be a great discussion with Doug Noland and myself. Doug's a veteran on the short side and understands the credit markets like very few alive today do. And so the conversation will be on the macro environment and also some of the aspects that we see in the financial markets today that are worrisome. What we've done in our offering with what we call tactical short, that's one of our managed products. We have more of a commodity-focused offering as well. But the tactical short, we've managed to outperform all of our competitors handily this last year. Now, outperforming and losing money are two difficult things to swallow at the same time. But it requires a tremendous amount of risk mitigation. We've had the markets melting up, and so to be short in a market melt-up is never comfortable. Mm-hmm. But we've done an amazing job mitigating those risks, and that's what we'll get into on the call this Thursday. And you need to register ahead of time. You can register at MWealthM. That's McAlvany Wealth Management, or MWealthM.com.
Mm-hmm. Very good. All right. Well, so we're in a melt-up, no doubt about it. Stocks are expensive. Maybe you could put that in some perspective for our listeners, just how overvalued, and can you compare them with a couple of other times in our history where I think we're pretty close to some of the tops, aren't we?
Yeah, it depends on your metric for valuation. If you're talking about price to sales, so looking at the sales of a company, if that's at all-time highs. So the price of the S&P, NASDAQ, and Dow are now at levels that have never been seen before on that metric. In terms of price earnings, I prefer a modified price earnings, which would be your cyclically adjusted price earnings, takes out some of the earnings volatility, puts us at 34.5, and we're the second most expensive market in U.S. financial history, the first being the year 2000 and the tech bubble. We're actually far more expensive now than we were in 1929 at the market peak there. A lot of leverage in the system in 29. There's a lot more leverage in the system today. I think these are some of the things that have us sort of up at night and maybe even up in the middle of the night. Mm-hmm. We ended 2015 with $210 trillion in global debt. And over the last 5 years or four and change, we've added $47 trillion to that. And for that extra $47 trillion in debt, we now have China, the number 2 economy in the world, at 29-year lows in terms of economic growth rates, and the U.S. Just kind of whimpering along at a sub 2% growth rate. And so, you know, what does $47 trillion get you these days? Not what you would think in terms of economic activity and growth.
Yeah, well, because a lot of debt comes along with that, of course, and that's the burden of a fiat currency instead of an asset-based currency. It's a little different. So we had David Rosenberg on this show last week, and he mentioned that it's just, you know, that the stock market is becoming so detached from the real economy. David's work suggested that a correlation of only about 7% to the real market right now, and he says that's in the past, he could see between 30 and 70% correlation between what's going on, economic metrics and the stock market. On the other hand, 95%, according to his work, is related to the money creation by the Federal Reserve. So ideally, the equity market should be related to, you would think, earnings growth, the real economy, and I guess to a certain extent, earnings per share have gone up, but as you've talked about in one of your podcasts recently, that's not really directly related so much to economic growth as it is to other factors. What are some of those factors? Maybe you could just talk a little bit. Why the equity market? Of course, there's tons of money going into the market at a time when interest rates are extremely low, so stocks aren't getting any competition from interest rates. But what are some of the factors that have really caused earnings per share to hold up as well as they have?
Yeah, and I think it's a careful distinction between earnings and earnings per share. Here we are coming to fourth quarter reporting, and companies in the S&P 500 are projected to report a 2% decline in earnings for the fourth quarter from the year earlier period. And if that in fact is the way it plays out, that'll be the fourth straight quarter of declining earnings. Now, everyone's enthusiastic about maybe earnings recovering, and where they gain their hope from, I think, is in part that piece that you mentioned, the earnings per share piece. So if I take, $600 billion to $1 trillion a year and use that to buy back shares, I shrink the total number of shares outstanding. And when I'm figuring my earnings per share progress, I shrink those total shares, and the math improves tremendously for me. Earnings is spread out over a fewer number of shares makes the EPS look much better. So that's kind of the smoke and mirrors game that's being played. Earnings in total are in decline, but we can play with the EPS number and sort of pretty up the pig, so to say.
Yeah, and I think you mentioned on one of your podcasts recently also that the number of equities, the number of stocks out there in the universe of the market, much smaller. I think it's almost, if I remember, something like half as many shares as there were a number of years ago. That is, number of companies that are trading in the market. So your supply has decreased.
Exactly, just under 8,000 companies listed, a dozen, 24 years ago, and now we're half of that, just under 4,000. And so you've got a shrinking number of companies to invest in, a shrinking number of shares outstanding. And, the interesting fact for me is always to watch the insiders in those companies who, taking advantage of the high price, are willing to spend company capital to continue to buy back more shares. But with their own shares, they're hitting the exits. So, insider liquidations, executive liquidations, not an encouraging sign. And I think history will be very unkind to the rules that allowed for that to happen, sort of a tale of two separate interests, personal self-interest in the executive suite and kind of how they abuse the Treasury, company Treasury dollars, to benefit themselves.
Right, so the companies are left with a huge amount of debt in many cases because some of these companies are taking advantage of low interest rates to borrow money and then buy their stocks back. And I suppose that works out very well for some of those executives who have options that they can exercise and pull money out of the company. I suppose that's some of what's going on anyway.
Yeah, in fact, there was a Reuters article a couple weeks back that covered that and basically said, look, corporate America has added about $1 trillion in debt each year over the last decade. It's about $10 trillion more in debt. Their big question was, where did the money go? That's the way the article described it or asked it. And the answer was, majority was share buybacks and dividends, special dividends. And so they haven't grown their businesses. The franchise have not necessarily improved. The cash flow and sales have not necessarily improved. But in the balance sheet, obviously, has not improved either.
Yeah. David, I imagine the next question I have for you will be partly answered, perhaps, in how to survive an equities melt-up that you're going to talk about on Thursday, but with Doug Nolan. But we see the Powell pivot, and now people are saying, well, wait a minute, there's no risk here. We can just buy stocks forever. There's no end to it. Well, we know there's always an end to things in this four-dimensional time-space continuum. But what could possibly go wrong? I mean, I'm sure that Doug and you will talk about some of those things, but if you maybe just give us a preview.
Yeah, I think a part of the issue is that people become less and less aware of risk as time goes on. And so there's less and less preparation for anything that might go wrong. Take, for instance, what it costs today to insure, whether it's a JP Morgan or a Goldman Sachs or, even a Deutsche Bank. We're talking about credit default swaps as an insurance product for that. And the difference in price on those versus Treasuries is minuscule, 0.5%. Whereas if you go back, and these are basically at levels that we haven't seen since 2007, prior to the global financial crisis. You get into a period of crisis, and then all of a sudden people start buying insurance. So that this is getting insurance in the financial sector, which is one place that we would kind of look for cracks to emerge. Mm-hmm. It's as cheap as it's been since 2007. Ignorance is bliss. Everyone's loving this market. There is no risk in the market today. At least that is what the wisdom in aggregate on display in the marketplace would say. Is there really no risk, Jay? I mean, to me, it's a little bit like this. The higher you climb the rungs of a ladder, implicitly, there's more risk. Mm-hmm. Mainly because you step off the first rung and you might, worst case scenario, twist an ankle. But from 25 feet up, mm-hmm. if something happens, anything happens, even something minor, actually, because of the elevated position you're at, the consequences are far graver. And that to me feels like where the market is. It's like we're on terra firma and haven't even stepped onto the first rung of the ladder, while in fact we're hanging like on the very top, standing on the top rung and claiming to have no risk in the equation.
Right. So see, another analogy I've heard is somebody's falling out of 50 stories and they're down past the 20th story or so, and they said everything is all right so far. Don't worry about it. So everything is fine. Everything seems so good, and yet when you look at these metrics and you look at the earnings and you look at the economy, the disconnect between the real world and the paper markets, which are stimulated by this funny money that's going into the system. David, both Michael Oliver and Alistair McLeod, who are two frequent guests on this show, have come up with very similar views on the dollar and commodities and interest rates, too, ultimately. But Michael, from his technical analysis viewpoint, and Alistair from a more fundamental perspective, both believe that we have actually started a bear market in the dollar. I mean, they're not talking short term, but longer term, and a bull market in commodities. And these factors are likely to cause, they believe, a rise in inflation. It will start to consumer inflation, essentially. Do you have any thoughts on that? I want to ask you about the worm turning, which was your article on December 6th, about sectors that were unloved before starting to come into favor. But do you have any thoughts on, it seems like inflation is something that happened in the 70s. It's never going to happen again. Any thoughts?
When the consensus view is that something will never happen again, you're getting pretty close to it happening again. And that's, I think, just a reality today, or I should say this week. Oxford University has gone back to the market to issue 100-year bonds. They did this back in 2017. And so roughly 2 years later, they're doing the same thing. Unsecured paper, 100-year paper, and the interest rate is right around 2.5%. Now, wow. Jay, tell me what part of 2.5% over 100 years covers your British pound exposure? It really is. We're not talking about the reliability of Oxford University. I think they're going to be here 500 years from now, let alone 100 years from now. But what does the pound sterling do in 100 years? Because you're talking about pound sterling denominated paper. So there's a complete disregard for the possibility of inflation over any period of time, which is remarkable. Because if you said, well, gosh, I don't think it's going to be a problem 12 months from now or 6 months from now, that might be a reasonable observation. But you are fighting every tidbit of history to say, I don't think inflation is going to be a problem 10 years from now, 20 years from now, 30 years from now, 100 years from now. And yet that's where consensus lands. Mm-hmm. So I think the big surprise will be on the inflationary side. And so a bear market in the dollar, look, here in the U.S., we're already on tap, if you're talking to the Congressional Budget Office, for $1 trillion in new debt per year over the next decade. Now, you throw us into a recession, and they're going to be more than happy to add to that trillion, maybe a half or a trillion more. And so you can see our debt levels moving up on a very quick basis. The discount to the dollar applied really going into bear market territory is not going to be a challenge. And frankly, it doesn't matter what the outcome is, Republican or Democrat 2020, you've got major problems for the dollar because we're already committed to the tune of $1 trillion a year budget deficit spending. So, yeah, I tend to agree with them maybe on the fundamental basis that the dollar has a tough road ahead.
Mm-hmm. I'm just wondering if those folks that are willing to lend Oxford their money for 100 years at 2.5%, must be thinking it's a foregone conclusion that the world is going negative rates. I mean, I think you had mentioned in a recent podcast that it was fairly, I don't know how many trillions, 14 or 17 trillion or something like that, of the world's debt that's in negative territory now. So maybe
I think this is one of the big transitions as we came through the end of 2019 and are now in the early stages of 2020, is that interest rates are moving higher globally. And you might say, well, off of a very low level, who really cares? But you had 17 trillion in paper, which was negatively yielding, then 13, and now 11. What does that tell you? It tells you that interest rates are marching up, and the market has yet to really acknowledge the fact that interest rates are moving up. Why are interest rates moving up? We're talking about German bunds. We're talking about, I mean, across the globe, we've already seen the lows put in. The only reason we would revisit those lows is sort of the desperate attempts of central banks to drive those interest rates to those levels. The market is, at this point, pricing in higher numbers, which I think, if anyone is paying attention, is significant.
Yeah, well, it's certainly, you just have to wonder what I would like to know, David, is how is the U.S. going to finance its deficit at these interest rates? And I'm wondering if you have any concerns about the recent instability in the repo market in the U.S. Is that telling you, and are you at all concerned about that?
Well, I think that the challenge with the repo market is basically hedge funds have figured out how to finance themselves directly from the Fed, and arguably you could say indirectly because there's one intermediary between the hedge fund community and the Fed. But that's actually in discussions to be eliminated as well, to give them direct access. Think of it, the largest leveraged speculative community the world has ever known, getting direct access to central bank money printing. What does that spell for you? Problematic at all? But this is what the challenge is in the repo market. It's not just funding, boring, plain vanilla money market funds. You're talking about 5 times leverage, 10 times leverage, 20 times leverage funds, and they're getting access from the Fed. So, yes, it's problematic, and what it means is that we're baking into the cake a lot of instability. And that's really where gold and a few other commodities, but gold in particular, shines very well, is when you have periods of gross financial instability. Financial instability, geopolitical instability, political instability. We may get sort of the trifecta of instability coming into 2020. Because, again, geopolitically, it's China, it's the Middle East, it's Europe, it's deglobalization, all of those trends. Politically, yeah, I mean, we've got our own levels of dysfunction here in the United States, none of which are going to be resolved from a fiscal standpoint with a change in someone sitting in the Oval Office.
No.
The real challenge, I think, is going to be financial markets. Valuations already tell you you're on the edge of a cliff. No. And, yeah, I think your contrary indicators are already telling you that, too. Bullish sentiment's way high. Difference between bulls and bears, about as much as you'll ever see prior to a major market crash.
Yeah, I saw that the explanation here for the repo spike at the repo markets was that the large banks, the 4 large banks that had been lending to the repo market, had really, or actually had before that, had been buying a lot of the treasuries, a lot of the huge amounts of treasuries that were issued, and they got to be treasury rich and cash poor, and they stopped lending to the repo market. In the repo market, and then the Fed had to step in because there weren't enough. So I don't know. That's my understanding. But I'm just wondering, do you see any real problem? I mean, that Donald Trump has anything but a fiscal conservative, and we're running huge deficits, trillion a year or whatever it is. It's big. And who's going to want to buy these treasuries at these rates? That's the question. And then I want to ask you about something else that you're doing in your firm. But do you have any thoughts on that? Who's buying our treasuries these days? Yeah.
Ironically, in a world that is as yield-starved as it is, there's a limitless number of buyers for treasuries at these interest rates. Look at this week with both the Italians and the Spanish, 4 times and then 5 times oversubscribed for 10-year Treasury paper, and we're talking about Treasury paper that yields far less than ours. How is that even possible? How is it possible that the inflation expectations and credit risk of the Italians and the Spanish is better than the U.S.? Something is very wrong in the world of fixed income when fiscal prudence shines brightly, a halo around the Spanish and the Italians. And I'm not trying to be jingoistic. This is just a reality.
Yeah.
They've never known how to run their fiscal ship rightly, and we don't either. You're right. The U.S. is just moving more in their direction, but you don't have accurate market pricing in fixed income. And that's one of the reasons why I think you saw gold move last year. In spite of the stock market moving up, you have a greater audience of investors saying this does not add up. There's risks implicit that are not accounted for in the price of stocks and bonds. We better do the smart thing and create something of a hedge for ourselves. So I think gold demand 2019 was a significant tell in terms of the chaos that's expected and likely to be a 2020 reality.
Yeah, I believe my engineer is telling me he says we have 2 minutes yet. So let me ask you this, David. At ICA, you do a lot of very interesting things with relative values, gold, silver, platinum, palladium, that sort of thing. Could you talk about that for a moment?
Yeah, so one of the things that has been on the minds of lots of investors lately is, gosh, palladium's going through the roof. Should we own some? Will it continue? And our advice is pay attention to the ratio between the metals, and these are the kinds of things that we put in motion for our clients inside of IRAs and storage accounts and whatnot. So platinum and palladium trade, as you know, and they're used similarly for industrial purposes, but the ratio between them is radically different. We would be moving from palladium into platinum at these numbers. It just did this for some folks, and they're increasing their ounces 11 times. So it's a pretty phenomenal thing. When your paper gains in dollar terms are up 5.5x, but your ounce gains are 11x, and that's in 12 years. It's taken us 12 years. These trades don't happen every Tuesday. Yeah. But over a decade or more, here we are with an 11 times gain. Just did this trade for a client yesterday. And so playing the ratios is important. If you're interested, we can get you a copy of How to Double Your Ounces.
Okay.
And How to Double Your Ounces, if you request that from our website or call our 800 number, 800-525-9556. That's a description of how we do what we do and an introduction to the team that's been doing that for 50 years very effectively.
Right. Excellent. Very good. Well, we'll have to leave it go at that, David, because we are out of time. I want to thank you so much for being with us, and we'll look to do it again sometime in the near future if possible. All right?
Thank you.